15 minutes, and then we discuss for the next.
Give you some recommendations.
He will also recommend some small cases and grabs. Thank you.
Okay, good evening everyone. I am Dr. Kaushal. I am practicing as a neurosurgeon in Aligarh, UP. So today's talk is on financial management for doctors. So I will like to dedicate this talk to Charles Thomas Munger, also known as Charlie Munger. He was the right-hand person to Warren Buffett, and I can call him Sachin Tendulkar of investing because he died 33 days before his 100th birthday. So disclaimer, I am not a financial advisor or a registered, SEBI registered. I'm just a finance enthusiast, and I like to share my things with you. So I've divided this talk into two parts. One is for the beginners and then the advanced stuff, including what are the strategies that we can use to beat the market. So why financial management? So financial management is necessary for everyone, not for doctors, but for everyone. Because we need to do budgeting, we need to manage the day-to-day finances, we have to make a fund for managing the emergencies, and we have to plan the children's education and our retirement. So I follow a barbell strategy. I am a moderate investor. I am neither extremely conservative, neither much aggressive. So these are some of the personal finance rules that everyone should know. I will be discussing them one by one. First, the emergency fund rule. So everyone should maintain an emergency fund, and this rule states that one should have at least 3 months of their monthly income in the emergency fund. You can extend it to 6 months, 12 months as per your risk appetite. There is one more thing which says that you should maintain an emergency fund which is equal to 12 times of your monthly expenses. Then we have the 40% EMI rule. This rule says that I should not have an EMI of more than 40% of my monthly income. So if I have an income of 1,000 rupees per month, then my EMI should be less than 20,000 rupees per month. Life insurance rule says that everyone should have a life insurance or term insurance. I myself have a term insurance of 2 CR. Most financial experts advise to take an insurance of 10 to 15 times of your annual income. So if you have annual income of say 10 lakhs, then the life insurance should be of at least 1 CR. So it is advisable not to take insurance for investment purpose, that is the unit linked investment schemes. Then the health insurance rule, everyone should have, we are doctors, but it doesn't mean that we cannot have health emergencies. So we should have health insurance as well. Health insurance, the minimum cover should be 3 times of the annual income. So if the annual income of the family as a whole is 10 lakhs, then the health insurance should be at least minimum of 30 lakhs. Then the rule of 72 says that how much time will it take in years so that we can double our invested money. So if my investment returns are 12%, then 72 divided by 12, that is 6 years. It will take 6 years for my 1 lakh to become 2 lakhs. Then we have the 50-30-20 budgeting rule. It says that 50% of your income should go towards your needs, 30% should go towards your wants, and 20% should be for financial goals, such as paying off debt or saving for retirement. However, I have modified this rule a bit. I say 50% should be needs and wants and not 80%. 30% should be EMI and debt, because that rule was created way back when banks were not giving so much money to people. And 20% should be for saving and investment. And of course, you should save and invest as much as possible. Then we have the 100 minus your age rule. This rule is used for asset allocation. So we should subtract our age from 100 so as to know how much equity, that is risk, should be in their portfolio and how much fixed income, that is fixed deposits or cash, should be there. So if my age is 30 years, then 100 minus 30, that is 70% should be in equity, and 70% should be in equity, and 30% should be in fixed income. Then rule of 70 is used for inflation adjustment. So it is says that we should divide by 70 the rate of inflation to find that how much quickly my value of money is decreasing. So if the rate of inflation is 5%, then 70 divided by 5, that is 14 years. So my 1 lakh will be worth only 50,000 rupees after 14 years. Now, where should we invest and what are the various tools for financial management? So right now my age is around 40 years. So 100 minus 40 is 60%. So 60 is my risk portfolio, that is the equities. Rest will be 40% will be in other assets. So 10% should be in saving accounts or FD or liquid funds. 10% should be in gold or debt funds. They will generate a ROI, return on investment, of 6 to 8%. Gold is very necessary in the portfolio because it's a safety net against inflation, emergencies, wars and calamities. Then real estate, at least 20% should be there. It will generate returns of 10 to 12%. And finally, equities should be around 60% at my age, and I should de-risk as my age increases. It will generate a return of 12 to 15%. So now this was the basic stuff. Now coming to the advanced stuff. Why equities? Why should I invest in equities? So equities is meant to beat inflation. So historically in India, the inflation has been 5 to 6%. And if I sit on that money, if I keep that money parked in savings account or fixed deposit account, the value of money will keep on decreasing. My target should be first to keep the value of money and second to grow that money. And of all the investment instruments that are available, equities have the highest rate of return historically. So they give us a ROI advantage. They also give us a power of compounding. That I will discuss later on. Finally, equities can give us financial independence. Now, financial independence means that if I don't work anything, I should have amount of money from which I should be able to keep my life, future life, completely free of any income. So also equities are meant for building up generational wealth. So compoundness is the 8th wonder of the world. We'll just see how. So if I have invested 20,000 rupees of money, say at an expected return rate of 12% for 20 years, it will be a whopping 1.84 CR after 20 years. My investment, that is total deposits by my pocket, will be 48 lakhs, while my returns will be 1.36 CR. Of course, this returns will not be linear; they will be non-linear. If we look this chart on, look this growth or compounding on this chart, we will see that for the first 10 years, I cannot appreciate how much money I am making or my money is growing. But after 10 years, this growth will be exponential. Same is with everything. If I am practicing what I am practicing today, and after 10 years, my practice will be flourishing. Same is with money. If I let the money to grow, after 10 years, I can expect the effect of compounding to kick in and the money will grow. So, what are the various options in equities? That is the stock market. We have index funds or index ETFs, mutual funds or ETF investing. Then direct stock investing we can do, stock swing investing, futures and options, and intraday trading. Now, as doctors, we may be confused what we are doing, trading versus investing. Personally, I recommend investing only, because trading for us is a loss of time, because in that time we will be making more from our practice as compared to trading in the initial phase of our life. So we should decide investor or trader. Investor, of course. Then if you see the Forbes top 100 list, you will never find a trader in that, you will only find investors in that. So investing is the way forward. Regarding leverage, I am of the same view as Warren Buffett. If you are smart, you don't need leverage. If you are not smart, you should not use it. investing, always remember that Rome was not built in a day. In trading, always remember that Hiroshima and Nagasaki were destroyed. So once you have decided that you are into equities and you want to invest in equities, you should have some basic knowledge about equities. First thing that you should study is theory. Like we have done MBBS, we have done MS, and further studies, we have first studied theory. So fundamental analysis is the theory of the stock market, or theory of the investing. So fundamental analysis means to evaluate the intrinsic value or the real worth. It can be qualitative or quantitative. Qualitative means competitive advantage of business model. Quantitative will include some of the ratios like the Alpen ratio, the PE ratio, etc. Then once we have mastered the theory, that is the fundamental analysis, we should move on to the technical analysis, that is the practical aspect. So technical analysis includes mathematical calculations based on price and volume, and it may include volume analysis or chart pattern analysis or trend analysis. Once we are done with these two things, only then we can think about market center analysis. Very frankly, I have still to decode this thing because this needs a lot of experience. And I just read the reports of Goldman Sachs and other big firms. They can give me a good idea. I have no knowledge about market sentiment, that how it is going to behave, what news is going to reflect. Then you should first define what type of investor you are. So there are usually two kinds of investor. The classical investor, the Warren Buffett way, we call it as the value investor. So value investor will be doing a dip buying. That is, they will be buying the securities when they are trading at a less price and then selling the securities when they are trading at a high price. So usually we use the 200-day moving average for that. Momentum investor will be doing the things completely differently. They will be buying at higher price and then selling at further higher price. So finally, can we beat the market? Is there any way to beat the market? Very frankly, we can beat the market, but we will understand like how. First thing is rebalancing. We should always rebalance our portfolio. Economists usually recommend that we should choose a day of the year which is usually your marriage anniversary is the best day to rebalance your portfolio. By rebalancing the portfolio, you will be achieving the desired asset allocation. For example, if you have decided for 60, 20, 20, then after 1 year, if it has become 55, 25 and 10, then you will be resetting it to 60, 20, 20. Then you should periodically book profits, so as you should be tax efficient, because the government allows that you can have an income of up to 1 lakh from long-term capital gains and that will be completely tax free. So how market returns work? Returns works in 3 ways. First is how much money can I pump in the market. So this will depend upon the personal growth of the person, that how much income I can increase. Only then I can increase my investment in the market. Second is time in the market, how much time I am invested in the market. And the third is rate of return. So the rate of return is the only thing that I can control on my own by making a strategy, and I can beat the market. So one thing is, does market timing works? That is, can I predict that when is the market the lowest and when is the market the highest? So there have been a lot of studies on this, and this is the data for the last 10 years, and it shows that there is no predictable pattern which sector will be performing, which sector will not be performing. We cannot say that COVID has come and the health sector will be performing and the pharma sector will be performing. There is no correlation at all. So these are some of the studies. So studies show that if I invest on the highest day of the market, or if I invest at the lowest day of the market, or if I invest systematically, the returns are not significantly different. They are almost the same returns. So how can I beat the market? So there was a theory in 1960s and 70s which says that efficient market hypothesis is there, that is, the markets are efficient. We cannot beat the markets at all. So they said if there is a market expert, they will make a portfolio, and there is a monkey who throws the dart and make a portfolio, the chances of beating the market are safe. So that was the concept of the efficient market hypothesis. However, there was a landmark study by Narasimhan, Jagdishan and Sargan Pittman in 1993, and they came up with the concept of momentum. So this was the first factor that was discovered, which was able to generate market beating returns and beat the market. So Eugene Fama has aptly said momentum is the premier market anomaly. So you can go to the website niftyindices.com, you can search for factor investing, and then you can go for the strategy indices. That is, there are several strategies that you can employ to beat the market. We have a equal weighted strategy, low volatility weighted strategy, quality strategy, momentum strategy, alpha value 52-week high strategy. My personal favorites are the momentum and the alpha strategy, although I also employ the 52-week high strategy. So this is the data which has been taken from niftyindices.com. So it shows that if we compare the last 17 years returns of the Nifty 50 with other indices, we can see the Nifty Midcap 150 index has beaten the market. But let's move on to the factor indices or the strategy indices. So we can see low volatility had beat the market, momentum has beat the market, and alpha has beat the market. So this is the thing that you can use to beat the market. That is, you can incorporate some form of momentum or low volatility or alpha in your portfolio to beat the market. So how can you beat the market? First, define your investing universe. That is, whether you want to invest in Nifty 50, Nifty 100, to Nifty 200 or Nifty 500 according to your risk appetite. Then you should define your strategy, which factor you want to use. If you don't want to take any risk, then you can straight away invest in Nifty 50. Then you should define your rebalancing period. That is, how much frequently you want to rebalance, whether you want to rebalance quarterly or half yearly or yearly. Then you should research and backtest, define the amount of money, start in unit. If you don't want to, if you don't have any conviction in the market, start with an index fund. So we have come up with a strategy which is referred to as the momentum weighting strategy. In this strategy, we are doing a fundamental analysis. We are using 5 scoring systems. These scoring systems defines that the stock is not fulfilling all the criteria for a fundamentals. So it avoids the pumps and dumps. Finally, we use technical analysis. Technical analysis is used for defining the stock position and how much stock position will be maintained. So conclusion is, we should establish clear financial goals, short-term goals, paying off debt, building an emergency fund, medium-term goals, and the long-term goals, that is planning retirement, achieving financial independence. If we want to achieve a returns of more than 20%, we should either research and backtest, or we should consult the expert. These are the suggested reading. This is my favorite book, Trading the Zone by Mark Douglas. If you can handle uncertainty, you can handle growth. I just finished reading Elon Musk. I would rather be optimistic and wrong than pessimistic and right. Thank you.
Thank you, Dr. Kaushal. Any questions?
Questions over the drinks.
Yes.
Just छोटा सा, you said that you need to have a Mediclaim which is 3 times your annual income.
So you are talking for doctors only, or you are talking general?
Anybody. See, on an average, if we see the kind of a treatment, most of the treatments which are done anywhere in India, 95 or also 99% of treatment are done within 10 lakh rupees. So if somebody is earning, let's say, 50 lakh rupees a year, so why do you take a 1.5 crore of a Mediclaim and pay so much of money? You take a 10 lakh rupees of a Mediclaim and take a 90 lakh rupees of top up, which hardly costs you 15,000 rupees for 3 years. Why you take that much of money? But I am not getting that thing.
Actually, the concept of top up has come just recently, sir, for last 2 to 3 years. This was not there.
1.5 करोड़ अभी हमने कहा इलाज कराना जहाँ 1.5 करोड़ रुपए खर्च होने वाला
I have one question for you. In your one of your slides, you mentioned about periodic profit booking for tax saving. What is that?
Sir, government allows us to book capital gains tax, capital gains. So if I have a long stock which I've been holding for a long time, I should partially sell it if I am in profit. And the profit that I can make is 1 lakh, and I will not be liable to pay any tax on that profit.
So every year 1 lakh of that tax is exempted. Exempted to see you do partial profit booking every year.
So if you make, let's say, a long-term capital gains of 2 lakhs rupees in one year, so you will be taxed for one, which would be 10%. So that means for 2 lakhs earning, you will be only paying 10,000 rupees.
So is it there to the new tax regime cycle?
In new tax regime also. It's nothing to do
For the
with
stock market, what is the long-term capital gain tax period?
1 year.
1 year.
For equities, 1 year. For debt, 3 years.
More than 1 year, it is 20%.
No.
15%.
1 year, 10%.
So more
Less
than
than 1
1
year
year
is
is 10%.
15%.
Less than 1 year is just 15%.
Less than
And
1
more
year.
than 1 year?
10%. 1 year, 2 year, 3 year. This is for equity only. For debt, 3 years.
So those which are in profit, that you can partially.
You can book losses also. And actually, you can save tax also. He is not talking about.
Okay, very nice.
People like him, that say